All right. What is up, tycoons? What is up, traders? Super excited for today's video. Things have been on an amazing rally, but today we saw the market get spooked out a little bit when Jerome Powell was speaking. All right, we're going to dive into why the bear market may be about to make a surprise return and go over a little bit of some of the bearish thesis. Even though, everything has been so bullish, okay, we do want to be aware of what the bears are saying and some of the different possible scenarios. So be sure to smash that like button, subscribe to the channel if you guys are new. All right, in summary, we're going to go over how the biggest tailwind for stocks over the past few weeks is now behind us. Liquidity is slowly being withdrawn and support hedging flows will end, and the stock market is positioned to give back most, if not all, of its recent gains. All right. Now, if you guys are interested, you can always check out today's sponsor, which is Simply Wall Street. There'll be a link in the description below, as well as a pinned comment. It's a really great platform to dive into the fundamental analysis of stocks. They have a really amazing website as well as an app. You can get a 14-day free trial as well as up to 40% off for the first 100 people. And you can always email me at exactlytrades@gmail.com if you're ever interested in a one-on-one trading coaching session. All right. We can work on setting up a time for that. Okay. Now, as always, the content provided on this YouTube channel is for informational and educational purposes only and is not intended to be relied upon as legal, financial, or investment advice. So please be sure to read through the full disclaimer. Now, Friday, June 16th was a significant point for the markets with option expirations now behind. The expiration of June options was important because hedging and option flows have been the most considerable drivers of the rally over the past 2 weeks. However, that is about to change with June OPEX now behind, the TGA refill underway, the Fed's more hawkish outlook, and rising rates. The recent rally in equities could falter as volatility expands from its lowest levels in years. Additionally, just in case Powell feels his message at the June FOMC meeting last Wednesday wasn't strong enough, he will be speaking in front of Congress on Wednesday and Thursday of this week to redeliver that message. Now, he just gave a speech today, all right, and we can see that the market was definitely spooked out, right? And we had a pretty significant drop there. Okay. Now, option flows have been the main driver. All right. And that's what this chart right here is visualizing for you guys. But most of the recent rally has really been driven by constant option flows that have helped suppress equity market volatility, giving zero DTE options traders, which, if you're not familiar with options, these are option contracts that expire on the same day. So they're 0 days to expiration. They're extremely volatile and they move hundreds, if not thousands of percent every single day. And so it gives zero DT options traders the ability to aggressively buy the dips, helping to keep markets propped up and moving higher. This is probably one of the primary reasons the largest stocks have been beneficiaries of the rally, since they account for the most significant portion of the S&P 500 index. Also, it probably isn't by chance that the recent move higher in the market was accompanied by record amounts of daily call volume for the S&P 500 options, right? And so what we're seeing here in blue is the last price of the S&P 500. And then we're looking at the total call volume, and you can really see just this huge acceleration of call volume. And every time we hit a peak in the call volume, we do see the blue line start to withdraw back down. And that's essentially what we got today. Okay. We saw this blue line come down. That's going to be the S&P 500 coming down. And we're starting to see that pullback. And if we see another surge and acceleration of essentially call volume, all right, there is a chance that the market can continue going higher. Now, what enables this massive grab for calls is falling implied volatility as premiums on call options get cheaper, allowing traders to buy the dip and take bets on the market rebounding intraday. Now, more recently, the S&P 500 50 delta 1-week option implied volatility fell to 9.5%, its lowest level since November of 2021. And this feature became apparent in mid-March when implied volatility dropped as call volume exploded to the upside. All right. And again, that's kind of what we're seeing here in this chart. All right, we can see call volume exploding to the upside in white, and then we're seeing that 50 delta 1-week option implied volatility falling to that 9.5% area there. Now, additionally, the VIX index has options expiring on Wednesday, and that was today, right? And because of this, it has been pinned below 16 due primarily to options positioning, with many puts now in the money. And assuming customers have bought these puts, market makers are likely short these puts, which means they need to be sellers of volatility or buyers of equities to stay hedged. So the further the VIX index falls, the more the volatility selling or equity buying market makers have had to conduct, right? And, we're kind of just seeing all of this play out today. A lot of things that we're talking about, we did see a pretty significant pullback in the market. Now, it doesn't have to mean that things are over, but could this be the beginning of the bear market returning back among us? That's what a lot of the bears are going to tell you right now. Okay. And so this creates a vicious feedback loop where low implied volatility fosters a risk on zero TDE call buying frenzy, coupled with implied volatility melting, forcing market makers to short volatility and buy equities, pushing prices higher, resulting in more risk-taking zero DTE trading activity. Now, additionally, call buying in general forces market makers to go long the market and remain hedged. So the more the market rises, the more market makers need to buy. If this is the case now with equity market options expiration behind us and VIX options expiring Wednesday morning, most, if not all, of this recent rally should unravel as implied volatility rises, killing off the zero DTE call buying frenzy with it and hedging flows halt. Now, this is the liquidity fade here. And so additionally, liquidity is being slowly withdrawn from the market, as has been noted by a decline in the size of the top of book for the NASDAQ 100 futures. This is likely due to refilling the Treasury General account, which is the TGA we mentioned earlier, which could lower reserve balances. All right. And if you take a look at the CME liquidity tool here, okay, essentially what you're seeing is the bid ask, and then the blue line here is the mid price. And you can see it's just been on a steady incline up here. So that's the book depth right there. Now, the TGA has been slow to refill to this point, rising by 227 billion since June 2nd, has partially been offset by a dip of 131 billion in the reverse repurchase facility. This has left reserves to this point primarily unchanged. By entering the second half of June should result in cash flooding into the repo facility, as it typically does heading into a quarter end, which, when coupled with the recent increase in the TGA, should lead to reserve balances dropping as liquidity in the broader markets drop as well. It would appear that to this point, the rally has been driven by market mechanics and nothing else. It probably has nothing to do with the market ignoring the Fed's more hawkish monetary policy stance or the market's fundamentals, which may be in their worst shape in a long time. And so what we have here, okay, is the reverse repo data. All right. And then here we have the TGA, the Treasury Cash Balance, Federal Reserve account. Right. And we can see the divergence right here in those, and really just giving a nice visual to everything that we just talked about. Now, the hawk takes flight. So these fundamentals will be tested with Jay Powell scheduled to speak in front of Congress on Wednesday and Thursday. If he delivers the same hawkish rhetoric and indicates that rates will have to go higher, the bond yields, and more importantly, real yields, should push higher. This is particularly dangerous for the NASDAQ 100 because it comes at a time when the NASDAQ is the most overvalued versus the 10-year real yield since 2007. Okay. And that's essentially kind of what we're looking at here as well. All right. Just kind of giving you guys some visualization, some graphs, according to these, right? So you have the NASDAQ here in white, you have the 10-year, all right, the 10-year real yield. Okay. And you can see that normally, these kind of, follow each other a little bit. Okay. You start to see the rally here in the real 10-year yield, and then you start to see the market rally here. And at this point here, we've seen a little bit of a divergence. Okay. Now, the idea that the market doesn't believe the Fed will raise rates again is false, because the December Fed fund futures have moved higher following June dot plots. The most significant changes on the Fed funds futures curve came from November 2023 to July 2024 timeframe, increasing by 15 to 35 basis points, a massive move in just a week. So indeed, the bond market is pricing in an even higher for longer interest rate path from the Fed. And you have to remember, the bond market is larger than the stock market, and oftentimes, people will refer to the bond market as smart money, and the stock market, which has a lot more to do with retail, as dumb money. Okay, and so smart money is pricing in higher for longer, and the stock market just continues to go up. Now, it even pushed the yield curve inversion back to its steepest point since Silicon Valley Bank's failure in mid-March, to nearly negative 96 basis points, an indication that the 2-year Treasury rate is again rising faster than the 10-year rate, as the market prices in more rate hikes from the Fed over the near term. Now, one important thing to realize, okay, is that most of the time when people talk about the yield curve inversion, okay, you actually get the recession after the yield curve uninverts. Okay, and we have not seen the yield curve uninvert yet, and that is really going to be the time when you would start to expect a recession. So a lot of the bears, they keep pushing the recession out longer, right? All of 2022, we were supposed to have a recession at the end of 2022 into heading into 2023. Now 2023 is halfway over, and they're really just guesstimating when the yield curve is going to uninvert and potentially see that recession. And now they're pushing out the recession to 2024 now. Okay, and really, in my views, they're really just saying that, hey, we think that maybe next year the yield curve will uninvert, or maybe later towards the end of this year, but they really don't know. It's all speculation. So, with mechanical flows likely behind us, liquidity slowly being withdrawn from the market, and the Fed about to ramp up its hawkish rhetoric due to sticky inflation readings, the stock market should begin to unwind the recent gains very soon, and we started to see a little bit of that today. Now, hopefully you guys enjoyed this video. If you do want to support the channel and help out, use the Simply Wall Street platform down below. There's a nice link in the description or the pinned comment. It's a really great platform that I've used for a while, and I was glad to have them as a sponsor. Very, very useful especially if you're not a pro at doing fundamental analysis. You can pretty much search any stock you want on there. And, if it's something that you've been wanting to invest in a long time, it's going to break down a lot of nice things in there. Okay. Like price to earnings ratio, your PE ratio, your price to sales ratio. It's going to look at, past performance. Okay. Give you some information about earnings. And it's got some very nice graphs. Okay. That are, really colorful and easy on the eyes to help visualize what you're also reading as well. And don't forget, you can email me for a one-on-one Zoom coaching session at zachleytrades@gmail.com, and we can work on setting up a time. Thank you guys for watching, and I'm out.